Welcome to Retail Retold, the stories behind how that store landed in your neighborhood. I'm Chris Ressa, in conversation with the people and stories shaping retail and real estate. Brought to you by DLC. Welcome to Retail Retold, everyone. Today I'm joined by Bill Fitzgerald. I'm excited for Bill to be here. Bill is a unique guest. He's in the solar industry. We've now been working together for a few years. I think he has some interesting insights to solar and how the interplay between the solar industry and retail real estate. Bill, welcome to the show.
Thank you, Chris. I appreciate you having me on. Looking
Yeah.
forward to discussing solar with you, how it intermeshes with commercial real estate, especially on the retail side where you occupy.
So Bill, why don't you tell a little bit about who you are, where you work, and what you do?
I'm Bill. I've been in solar for about 7 years now. I've always been intrigued with real estate ever since I picked up a book written by Gary Rappaport. And it was after picking up that book that I really started to understand some of the basics associated with real estate. And I had a knack for solar and understood that, and really putting the two together really gave me a good understanding of how solar interplays with commercial real estate, how there is a symbiotic relationship where we're able to help drive value add, help drive NOI to commercial real estate owners, and putting those two tracks of knowledge together. I've gone through my career in solar really leading origination teams. So you could think of an origination team in solar like leasing in real estate. And so what I do every day is I get out and I find the sites that work best for solar, just like your typical retail tenant would want to find the sites that work best for them. I'm out there every day looking for the sites that work best for us. That's typically rooftops, 50,000 square feet and above. Retail, industrial tend to lend themselves the best to rooftop solar. And so groups like yours, Chris, DLC, has a set of very valuable solar sites, and some of your peers do as well. It's my job to go find you and do deals with you, get solar on your rooftop.
What an excellent explanation. Okay. And so pivoting off that, today you're at Radial. Want to tell a little bit about who Radial is and what you guys do?
Yeah, absolutely. So Radial Power is actually born out of Starwood and Related. They came together with John Bates, our CEO, and there was really one core mission they wanted to solve: is how do we drive the monetization of rooftops and drive sustainability through rooftop solar. And so Starwood, through their affiliate Energy RE, and Related through their affiliate Energy RE, and Starwood through their affiliate Lotus Infrastructure Partners, became our corporate sponsors. So they really injected the lifeblood into our company to get it off the ground, to get it started with John. We started solarizing their assets as a tenant. So solar as a tenant model, where we came in and were able to help them drive NOI to their sites. And then we continue to pick up more and more commercial real estate partners to add solar on the roof. So Radial is really, if you really think about Radial, you could boil it down very simply to: we're a rooftop tenant that helps landlords drive net operating income in addition to hit some of their ESG goals.
Well, first off, that's powered by Radial's powered by some heavy hitters over there, some big names in commercial real estate, no doubt. And I like the concept that you talked about, and you mentioned that you guys are a tenant and you're building these solar assets primarily on the roofs of shopping centers and industrial sites. But there's really two ways right now that like people are creating the operation of solar on improved property. And can you walk us through those like two? There's probably more, but generally speaking, there's like two ways that people go about it. And you guys really are in one way, which is your I'll let you speak to the two ways.
Yeah, yeah, absolutely. So, um, y- somebody can either go about solar owning it themselves. So, so for example, a group like DLC could, just like you develop real estate, do value add on real estate, and add GLA through out parcels, etc. And you figure that whole scheme out. You could figure out the solar game, um, put up your own capital, purchase the solar, connect it into the grid, because the vast majority of the times, especially on these on assets where it's triple net lease, tenants paying electricity, you're not actually selling the energy on site, you're selling it off site to the grid. So what you could do is you could do that. And there are some groups that do that. But by and large, the vast majority of the people, they choose a different route, the second route you were talking about, which is simply leasing the roof out. So um, continuing to be a landlord and simply using the rooftop space as additional GLA for solar tenants like a radial power. So what we do, and the way we operate differently than if you were to come in and purchase solar, operate it yourself, put it together, develop it, put your own capital behind it. What we do is we say, Chris, just give us your rooftop square footage. We'll do everything else, and we'll stroke you your rent check. So what we do on the back end is we have the capital stack to fund these deals. Equity, tax equity, debt. We put all the three of those core financial components together, which is really how we finance these deals. We put that together. That's how we pay for the deal. Then we set up the various revenue streams. So we monetize not only electricity, we monetize the any state incentive, any federal incentive, um, and then we're responsible for that, right? And so we monetize the energy, we sell it offsite, typically in what's called community solar. And what that to boil that down very simply, that just means we're installing the system. The power is not being consumed on site. In fact, it's not even connected to your building's electrical infrastructure, straight from the roof to the grid. Um, Folks out in the area are purchasing that electricity from us. We find those clients, we find those customers. Then what we're doing is we're monetizing the state incentive. Usually, a state like Maryland, Massachusetts, Connecticut, etc., New Jersey, they'll have a state incentive. A lot of times that's in the form of a renewable energy credit, which is a environmental commodity. We monetize that commodity, and ultimately we take that brain damage off of a landlord's hands from having to figure all that out and how to monetize it and how to upkeep it, how to run it, and then we monetize those streams of value, and we package it in the form of a rent check to you.
Okay, so there's a lot there, super helpful. Generally speaking, it was a very good explanation. Generally speaking, your capital stack is three areas. It's traditional debt, equity. That's like the untraditional, the real estate, or not untraditional, the less common, and then the equity that funds your deal. And then you now use that to create an asset. The asset you're creating with that capital stack is a solar asset. That solar generates power, and you sell it off-site, and you generate revenue that way. And then the other way you monetize is you take the environmental credits that are given and you package that up and you sell that and you monetize that. And are those the two main ways? Is there a third? Did I miss
Yeah.
one?
So there's so you got all three. So it's the tax equity because we're getting a tax credit. So the best way
Oh
to
yeah,
think
the
about
tax
that
revenue. Yeah, that's right.
is the best way to think about the tax credit um, is it's similar to LIHTC. And so if folks are on the podcast who are familiar with LIHTC multifamily development, where you're getting tax credits, we're essentially doing something very similar to that. So we're getting a tax credit, we're monetizing that with a tax equity partner. That's more or less a one-time hit, right?
That's one
That's a one-time
monetization.
value, right? Then
And
we have two.
that's why, by the way, there was a lot of initially there was a lot of people who were in the affordable housing game that got into solar because the equity game was very similar, correct?
That's exactly right.
Right.
There's a ton of parallels between affordable housing, light tech, tax credits, and solar. So it's very similar capital stack. Then, in terms of going back to the revenue side, so we've got that one lump sum, more or less, stream of value. The other
With the
two
tax
streams of
equity.
value that we're getting are sale of electricity. So we're selling all the electricity that we're making off that rooftop. We're selling it into the grid. Every state has a different jargon of what they call that when you do it. In many states, probably the most common phrase for it is community solar. So we're selling solar energy out to the community. And pretty much what we're doing, if you're trying to draw a real estate parallel, it's almost like that's the leasing of our product. We're leasing, if the solar energy is our asset, we're going out there and we're releasing that power to folks. We're selling that power to folks that are offsite. So not your tenants on premise. We're selling to households in the community. We're selling to businesses in the community. And there's all kinds of stipulations, just like affordable housing, like you mentioned. There's all kinds of stipulations with what you can do with that power. So one of them is in most states is that we've got a quota in terms of that we've got to meet in terms of selling a certain amount of power to low and moderate income families. So in Maryland, it's very roughly 30% of power we've got to sell to low and moderate income households. The rest of the power we could sell market rate to whoever we'd like. So there's all kinds of different rules and regulations that dictate where the power's got to go. But by and large, one of those streams of recurring revenue is electricity, and it's sold offsite. And there's some regulatory quotas that we've got to hit around making that energy affordable. The third stream of revenue that we've got is our state incentives, and that varies from state to state. One of the most common and popular state incentive structures is called a renewable portfolio standard. A renewable portfolio standard says, let's just say the state of Massachusetts says, we want X percent of our power to come from solar by year Y, by 2035. That's called the renewable portfolio standard. So they say coal, nuclear, hydro, all these various forms of power exist, but we want a goal of having 5 or 10 or 15% of it come from solar, come from wind, etc. So they set up these goals, and one of the ways they incentivize developers like us to help them achieve those goals is that every time that we develop a system and generate electricity, for each unit of electricity that we generate, usually measured, it's called a megawatt hour, we get a environmental commodity that's marketable and tradable. That marketable commodity is usually called the solar renewable energy certificate. Some states have a different way to incentivize this, but this is one of the most popular ways. So we're making congruent with each unit of electricity we're minting an environmental commodity. That environmental commodity can be bought and sold. And in fact, there are people who need to purchase those commodities, other folks in the energy space, in order um, to comply with the regulations who fall short of that renewable portfolio standard have got to buy that from us. We're going a little bit into the weeds, but long story short, it's a marketable commodity and we're getting recurring revenue from it, just like the electricity. So between the tax equity, one-time hit that really helps us reduce our effective capex in the front, and those two recurring streams of revenue, that's how we're able to monetize it. That's what it looks like from a project sponsor developer's point of view.
Excellent explanation. Thank you. Why are the utility companies themselves not doing this?
It's a great
Right?
question.
Instead, right? Like they're letting you get into the grid and sell electricity cheaper than they are, right?
So it all has it's all got to do um, it's all got to do with a lot of it has to do with the regulatory schemes in place from state to state. So there's fundamentally two kinds of states. You have regulated states of regulated utilities and unregulated utilities. And so typically the states that we operate in are unregulated, or they have some sort of special program or carve out for solar that allows us as independent power producers, developers, owners, and operators of solar to operate. So for instance, if you go into the Carolinas, Georgia, Florida, Louisiana, Mississippi, Arkansas, and I may not get all of those, correct. Those are generally regulated states and it's very hard to do what we do in terms of what we call front of the meter solar. We're selling power not behind the meter to the building, but in front of the meter out into the grid. It becomes much harder to do that in those states. However, if you go from, I'm generalizing here, but from Maryland up to Maine, um, crossover to some parts of the Midwest, especially Illinois, some parts of Minnesota, um, uh, some parts of Texas, especially in the Austin area. We're from a regulatory perspective, they make it a much easier for us to come in and generate power that's sold into the grid. So a lot of it's regulatory, Chris, and that's why solar is very geographically sensitive. For instance, just to give you a good example, in many cases, I'm paying 80 cents a square foot for roof space, and sometimes if we've got a very big roof, $1 per square foot for roof space in Maryland. Whereas if you go across the Potomac River into Virginia, I'd be hard pressed to pay you 5 cents per square foot. So quite literally up to a 95% reduction in value. The sun strength is relatively, the insulation that you get from the sun is relatively similar, but I'm only able to pay you 5% of what in Virginia is what I can in Maryland, despite the fact that they're next to each other.
And that's because of the regulatory environment.
That's a regulatory environment and the incentive environment. So those renewable energy commodities that I mentioned in Virginia are worth a fraction of what they're worth in Virginia. And then further, it's also got to do with power prices. So folks in Virginia enjoy a lower cost of power than they do right across the border in Maryland. And so we're not able to monetize energy for as much money. You can almost think of it like price per square foot for rent. If you're in an in demand area, your tenants as a retail landlord are going to have to pay you more money per square foot. But if you're in a less sought after area, the price per square foot is going to be less. So that's a big driver, not only the incentive structure, but also the price for electricity.
Bill, this has been amazing. That's a super helpful explanation. What about solar and the industry and how it works haven't we discussed that we should?
So one of the things that we should discuss is the fact that a lot, because this is a relatively new phenomena that's only growing and it's popping up in more states and geographies across the country in terms of a viable NOI driving opportunity. One of the things I think that commonly gets lost is that solar providers like Radial Power are really tenants. A lot of times when I pick up the phone and dial somebody or shoot somebody an email, they, their first intuition is that we're selling them a solar system. We're selling them the solar infrastructure.
Interesting.
Couldn't be further from the truth. The truth is, as we've gone through in this conversation, is that we're taking care of all costs. We're taking care of all development risk. There's not a single dollar outlaid by our landlords, and they're getting NOI. Now, they're not getting the same NOI that they're getting per square foot from the building envelope, but they're also, on the flip side of that, we're using space that is otherwise not valuable. So typically, depending on the geography, we're paying anywhere between 30 cents to $1.50, $1.75 a foot, depending on where you're at. And it's purely accretive NOI that can be used, one, after you purchase an asset as part of a value add campaign, or number two, before you sell an asset, to run our additional NOI through the acquisition pro forma. Hopefully, the purchaser will cap that at whatever they're valuing the rest of the NOI at. So it really makes for a zero capex value add endeavor. And when I think about other zero capex value add endeavors, there's not that many. That come front of mind. You usually have got to put some sort of capital expenditure out in order to get the value. So it's a really offensive NOI move.
Bill, this has been great. I really appreciate the time. Looking forward to seeing you at the ICSC Las Vegas. Thanks so much for joining the show.
Flip, Chris, I appreciate you having me on.
Awesome. Thanks, man.
Of course, I appreciate.
Appreciate you watching. Hit subscribe. See you in the next one.